and welcome to India Market Open. And it's been 7 weeks of a solid run for the markets. Of course, we'll gear you up for trade this Monday morning. I've got Agam and Tamanna joining us today on the show. Tamanna, Agam, it's been a very solid run for the markets. The December came much earlier, and it continues to look good as we speak. Of course, GIFT Nifty is indicating to a slightly muted start this morning, but global cues first, Tamanna.
Oh, just fantastic. What a streak it has been. So global markets have also, Wall Street has also shut up for a 7th week in a row. The question this entire trading session and today is going to be, is there steam left? Are we going to see a set of consolidation now coming in after Friday's fantastic run? And what will be the factors going forward which will actually determine that kind of market strength? And we're going to get into all of those details with Agam, Samina and myself. But let's just tell you how GIFT Nifty is looking this morning. Looking like it is in the positive territory, so that's good. Asia is a bit mixed. You've had Asian markets take a breather. They're awaiting data. There's a Bank of Japan policy meet, so that is also in the fray and on the mind of traders. But let me take you through what's happened in the US on Friday close and where bonds and, of course, oil is settling in. So US markets have seen a phenomenal run, a lot of strength there coming in. So Wall Street notched up 7th straight week of gains. You had the Nasdaq close at an all-time high. The Dow hit an intraday high, so a record high as well during trade. That has been continuing quite positively. There was, though, a note of caution, which was expected. After everyone's been celebrating the Fed, it cannot go on forever. So the New York Fed Reserve Chief has said, and John Williams has said in various interviews, made those statements saying that he thinks rate cuts are, quote unquote, premature. So that may weigh on the minds of markets at some point, though thus far it seems to be ignored. The larger consensus seems to be that at least those 3 rate cuts, if not 3 to 5, are coming next year. Quick check on how crude has fared, and perhaps there you saw a bit of run up as well. So crude around 77 on the Brent. The 10-year Treasury slipped to 3.93% on rate cut hopes, and Brent up to 77 per dollar. So those are the broad global cues, still looking very, very positive, but the action now, of course, will shift to what's happening domestically. And before we come to Agam on the trade setup, Samina, just a quick recap of what a week we've had and what a Friday we had.
Indeed. And before we go into the equities rally, I want to quickly mention what happened in the dollar-rupee market as well. Now, that was noteworthy. The rupee broke the levels of 83 against the dollar. Now, this hasn't happened over the last 8 months, to be precise. We closed the day at 83 rupees against the dollar. But what's worth noting is dealers have attributed this unexpected rally on the currency to fundraising that was seen by Indian corporations, in addition the foreign portfolio inflow that's been expected. Remember, custodian banks came in with a massive demand for the rupee in Friday's trade, which did lead the rupee stronger to close the day. This, in addition to the fact that the dollar index is trading closer to levels of 102, only added fuel to the fire and helped the rupee close on a strong footing. Well, that, of course, is the currency markets. We'll watch out for how the dollar rupee plays out in opening trade this morning. Expectations are we should see a little bit of weakness on the local currency. But let's take a quick check of what a week it's been, what a month it's been. In fact, what a great 7 weeks it's been for the markets. The Nifty is up 700 points in the last 3 weeks. We're up 6.5% for the month and 2.5% for the week itself. The index has gained for 7 straight rows. Like Tamanna indicated, this is not specific to India. Global markets, including the Dow Jones, are up for the last 7 straight weeks. Nifty is up 2,500 points in the last week of since the last week of October. Well, a couple of sectors that supported the Nifty. Bank Nifty, remember, was wearing the crown up until a few days ago. Bank Nifty is also growing substantially to close above levels of 48,000 on Friday. Bank Nifty has gained for 4 straight weeks in a row. Well, that was clearly the big support coming, and Agam will dwell more into that and what it really means as we gear up for trade this morning. Another sector that we cannot help but talk about is the IT pack. Nifty IT gained 4.5% itself on Friday. This usually sounds like numbers for the week, but this is a one-day gain coming in for Nifty IT, in addition to a 3.5% rally that we saw for the same index on Thursday itself. It trades at a 20-month high, and also what's important to note, and Agam, maybe you can dwell on this a little bit more. Firstly, these numbers don't sound like daily numbers, but reality. These are daily numbers we are referring to. IT index, Bank Nifty. I think IT is doing what Bank Nifty did exactly a week ago.
Right.
But what catches my attention, Agam, is the fact that the Nifty PCR is about 1.45, indicating a little bit of consolidation, and also broader markets underperformed on Friday. Now, that is again an aberration, right?
Sure. So let's start right at the top. Now, we are talking about the Nifty, 11 straight sessions of gains coming in, a stupendous rally, clearly well into uncharted territory for now. We're looking at about a 30,000 crores added just in the last, 11 sessions as far as FIIs are concerned. DIs have also bought into in the same period. So we're clearly seeing a lot of buying coming through. The question is that this is around the time when we start looking at conjecture, looking at guesses. Are we at the top? Are we at the market top? Is the market overheated? The market's been overheated for about 2 weeks, at least if you go by conventional technical parameters. That said, as far as your FIIs, long-short ratio is concerned, that's at 60%. It's somewhere close to the top. So it's around 70%. You, in fact, start seeing markets to taper off just quite a bit. Samina, you mentioned about the Nifty put-call ratio being at around 1.47. Yes, it certainly is somewhere near the top. The highest that I have seen is around 1.6, 1.65, but that happens once in a lifetime. It's not every day that you, in fact, see that number. But once you see the number hit 1.5, you perhaps are going to start seeing some of the traders who are longs becoming a little bit nervous and perhaps starting to book their positions. That said, what are the big movers this week? Of course, we saw IT move up as much as 7%, and a lot of that was account of the last 2 days in the last week. So Thursday and Friday essentially were the reasons why we saw that up move. Let's not forget that PSU banking index along with the metal index is also providing a good amount of support as far as your benchmarks go and your broader markets as well. And at the end of the day, the question really is, what do you do with the Nifty? What base are you looking at? We're firmly above the mark of 21,000. Should the Nifty slip below 21,000, we'll move into a range of consolidation. We're not necessarily going to see a sharp correction. That usually does not happen when you, in fact, see such a swift up move on the benchmarks. But for now, of course, the base level is around 20,700, 20,800. And besides that, on the higher end, both for the December 21st as well as December 28th expiries, you're looking at a lot of accumulation around 22,000 as far as the Nifty is concerned, the 22,000 calls specifically. It's highly unlikely that we will go there. In fact, it's probably unlikely that we're also going to hit around 21,500 through the course of the next couple of weeks. But where do we go from here? That's a wait and watch. These are the levels that at least the traders are suggesting that they're playing around with.
You know, what is also the big push is the kind of foreign flows that have been coming in, and I just want to talk a bit about that. That Christmas break will see that effect waning, and just the provisional figures from Friday is giving you an idea of how huge it is. So 9,239 crores, remember NSE figures, have seen inflows on Friday. Just for context, that was more than the entire month of November. And it's a sell by domestic institutional investors, about 3,000 odd crores again on Friday. But I just want to expand that to give you a sense of how much has been bought just this month. So if I look at FPIs in equity just this month, it's 42,733 crores in December. While in all of this year, in 2023, FPIs have infused about 1.5 lakh crore rupees for the year. So it really is going to depend on whether those breaks are being taken, whether more enthusiasm or money is going to come in, or is being staggered for January. Now, having said that, I think it's also a lot of excitement in the primary market. And Samina, you wanted to talk about that.
Tamana, just one quick detour before we talk about the primary markets. And Agam, I wanted to talk to you. We've put enough focus on how well IT is currently doing, right?
Yeah.
What is also noteworthy, and I think this could be one sector that could potentially provide support to the markets this week, could be metals.
Yes.
Commodities across the board are looking good. China, of course, is expected to come out with some form of stimulus which will support the likes of copper, aluminium. And the dollar index sub 102 is another big driving factor for metal names. And if you look at metals across the board, barring, of course, your Hindustan Zinc and JSPL, every other metal counters ended deeply in the green on Friday.
Yeah, you know, Samina, had it not been for the Federal Reserve suggesting that there will be rate cuts next year, and had it not been for the IT index, the other two sectors which were in fact supporting the markets were the metal index and the banking index. And it was the metal index which was in fact taking the lead out there. So clearly, you know, there is a point there that the fact that we are seeing a lot of support. And I reckon to a certain extent, a lot of these market participants have already taken that into consideration.
And despite a 15% rise on the metal index, it still remains the worst performing sector in 2023. So that will be one sector that could see some low-level buying, low-level relative to the rest of the market over the next couple of days. Well, a quick mention, like Tamanna said, it's lots and lots of money that's finding its way into India. We've also seen the dollar inflows that we saw on the currency markets on Friday. But let's tie that into what's happening in the IPO market. You've got 12 companies who will be opening their IPOs through this week. So you've got 8 new listings. Quick mention, 4,600 crores of fundraising will take place by these 12 companies. Last week we saw 4,000 crores being raised from the primary market. The few names that you're watching out for today, you've got Muthoot Microfinance. They are looking to launch their IPO. Motors and Jewelers, Suraj Estate Developers are the 3 that I mentioned that are opening in today's session. These IPOs will close on the 20th of December. So watch out for these 3 names, and those are going to be on top of your radar. This is where a lot of the money will find its way in the primary market. So that's largely the IPO business, but lots of stocks as well. Tamanna, we've got enough and more to watch out for today.
So this happens every Monday, right? Because you have post-market close Friday news flow, and after that a whole set of news, and this has been a particularly newsy weekend. So I'm going to start with Zee Entertainment, definitely a stock to watch today, and they have requested Sony to extend the timeline for the merger. Now, this becomes interesting because behind the scenes, there's news of a tussle on management and who will lead the joint venture, and will this finally happen after all of those delays? But brokerages are maintaining a positive view on the stock, saying the extension of merger timeline is positive and in line with expectations. So let's see how Zee responds there. In fact, Elara has given a target of 340. Solar Industries is another one that I would mention. There was an explosion incident, unfortunately, very unfortunate, at their factory in Nagpur, which has resulted in the death of 9 people. 3 have been injured. An incident is being investigated for all root and contributory causes. We'll keep a watch for Solar Industries. And Lupin is another one that I would add. The pharma major has received US FDA approval for 2 drugs. These are abbreviated new drug applications, and this might be another boost for Lupin as well. We will be talking about the big news on sugar with a conversation on context as well. But meanwhile, Samina, what else is on your list of stocks?
A couple of other names, Tamanna, that we're watching out for in today's day of trade. I'll quickly take you through what we've got on the radar. Mazgaon Docks is one you want to watch out for. They've won an order to the tune of $42 million from a European client for construction of 3 vessels. Stock was subdued on Friday's day of trade, but could be one to watch out for, given that the size of the order is significant for Mazgaon Docks. The other one that we have on the radar this morning is Gandhar Oil Refinery. We don't have too much to compare their earnings to, given that it's a recent listing, but the stock itself will see a little bit of a reaction coming in. To take you through what those numbers are, their revenue is up 6.5% at 1,000 odd crores versus 1,070. So almost terms of 6.5 to 7% gain on revenues. EBITDA margins have come in at 7.58 versus 7.85. So slight downtick on margins, if that's worth a mention. Net profits are up 11.4% at 48, down actually 11.4% at 48 crores versus 54.237 crores. Remember, the company listed very recently. It was subscribed over 66 times. The listing was 75% premium. The stock trades 4% higher higher from its listing day. So what you're seeing on the screen is 309.70 rupees is what the counter closed at on Friday. This morning, though, could see some selling pressure emerging on Kandahar Oil Refinery. Another quick one in the slew of QIPs we've seen, Indian Bank will also look to raise 4,000 crores via QIP. The issue size is about 10.15 odd crore shares, and the price band is 394 rupees a share. That's the floor price, which comes in at a 5% discount to Friday's close. But those are a few that I've got on the radar. But Agam, lots of smaller sectors, lots of other encounters. Today is a busy day for all of us.
Yeah, it has been. But, we'll very quickly talk about sugar just a bit, because we understand the government has lifted the ban for the use of sugar towards ethanol. Of course, this is putting some limits in place at the moment. But based on that, we have seen a lot of volatility across the sugar sector over the course of the last 1 week, because we've had this a little bit of a to and fro as far as the government policy on diverting ethanol towards OMCs is concerned. Based on that, since the 7th of December notification, we have seen Balrampur Chini, something like that, come off significantly. Some amount of weakness in BCL Industries, along with Bajaj Hindustan as well. But on the whole, of course, we must remember that Balrampur Chini is also in the F&O ban. So that is also something which is going to weigh on some of those counters. But on the whole, yes, sugars will certainly be in focus at the moment.
So the government has allowed both sugarcane juice and B-heavy molasses for the use of ethanol with an overall cap of 17 lakh tons. Is this the relief that the industry was hoping for? M. Manikam, Chairman and Managing Director at Sakti Sugars, joins us now for his take. A very good morning, Mr. Manikam, and welcome to NDTV Profit. Great to be speaking with you today. Yeah. Hi. So let's begin, Mr. Manikam, just by understanding whether this is the relief that the industry was looking out for, and with that cap of 17 lakh tons, is it enough for the kind of targets that sugar companies have?
Now, the original targets that the government had planned was about 3.2 million tons of diversion. So now they've allowed about 1.7 out of that. So I think still a quantity of 1.5 million is remaining. I think government wants to be cautious to make sure that we have enough sugar production before they will release the other 1.5 million as well. But this is a welcome step. At least they relaxed a little bit.
What are you expecting in terms of more relaxation, and how much is the dependence, if you can give us a sense, on sugarcane juice for the primary ethanol manufacturers, Mr. Manikam?
See, relaxation is basically government has to get out of this sector. That's ultimate relaxation we would need. You know, what has been happening in almost all agricultural commodities, whether it's sugar or cotton or rice, wheat, tomatoes and onions, government always reacts very, very quickly. And, sometimes it's not conducive in the long run to allow the marketplace, the forces to, play and stabilize. So this is a basic problem that we've been seeing, and this is not new. This has been on for the last 50, 60 years, so I don't see a change. Ethanol was a welcome policy. People had said that, this will be helping sugar industry stabilize, which it did. But then now, again, with the government taking, one step backward again, it gives a certain amount of fears in minds of people that it can go the same way as the co-generation did. So it's the same fear that we have.
Mr. Manikam, hi, this is Samina, and I wanted to extend that conversation you and me had last evening about how much the industry has invested in ethanol. We're looking at 15,000 odd crores, and this constant back and forth of the government intervening, changing regulations, now putting the onus back on the OMCs. This sentimentally is not going to work. I know you and the rest of the South sugar players haven't invested heavily in ethanol, but this is a high margin business and it will impact earnings for some of these companies, right?
It will, because in fact, the reason the southern plants have not invested for ethanol, mainly that we had invested very heavily in co-generation, and we lost out because of the new Electricity Act which came in 2011, which turned the whole thing, topsy-turvy. So that, I think all of us had, second thoughts, and that's why we didn't go in for ethanol in a big way. But now, I think, the general feeling was that ethanol may not go the way of electricity, but it's also looks like it's going the way of electricity. So this is a fear that we have. And investments that has been made are based on a certain premise. And I'm sure, I think these millers will be asking for some compensation from the government for non-utilization or capacities and all that. So if that is done, it's still. But anyway, the investment is wasted. It's a wasted national effort. So basically, the government should be looking at long term and not have knee-jerk policies like this.
Last question, Mr. Manikam and Tamanna here. The target of the government is to have 20% blended ethanol by 2025. And of course, the broader idea is a cleaner environment, less emissions, less dependence for India on imported crude, etc. Are we looking like we are set to meet that target in the current situation where food inflation has also become a big concern?
Possibly. I don't think we're going to really look at meeting the targets at this point of time. And while you talk about food inflation, the inflation on everything else has been going up. The oil prices, governments do pass on the price increase all the time regularly, right? And food inflation is a minor part as far as the whole index is concerned. And sugar even less so. But these are controllable by the government, and so they do control it. They can't control oil prices, obviously. So they can control food prices, they're controlling this.
Very lastly, Mr. Manikam, what is the outlook on prices? I believe demand will be stable, so volumes will of course remain largely unchanged. But with more supply coming in, could sugar companies face a little more pressure on sugar pricing?
Not really, not so far. We have not seen what is going to be the production. So only thing is, with this kind of a change in policy, the shortage will be averted. We're not looking at a surplus. We are looking at a situation where the shortage will be averted, so the prices may not go further. But I don't see a downside on prices at this point in time.
All right, Mr. Manikam, we leave it at that. Thank you so much for joining us and taking us through your views on the sector. But on that note, we move on to the editor's cut. And this time we're talking about State Bank of India, along with the IT sector, the surge in there, and of course, what could the preference be in the IT sector as well? Handing it over to Alex. Back to you there, Alex.
Absolutely. Agam, thanks so much for that. This is the editor's cut, ladies and gentlemen, and this is meant to give you some perspective on the key ideas to take into the trading day. And of course, some of these conversations are longer term in nature. These that are lined up today are meant to help you understand what to do with your longer term portfolios. And we're talking, as Agam pointed out, about the IT sector. You've seen a significant run up in the stocks across the board in the IT space. And you've also seen a run up in a few banks, State Bank of India, one of them. We're talking about valuations. We're talking about why IT stocks are going up. Let's start with that IT conversation, right. Agam. And the run-up started when we got certain amount of clarity about the number of rate cuts that we could expect from the Fed in 2024. Right. I guess to a certain extent, market watchers are saying that the worst could well be over. Right. But is the worst really over on the earnings front?
Sure. So, Alex, two things. Of course, a lot of these projections are going to be on account of what FY25 holds in store. Naturally, an improvement in business environment, considering we could see potential cuts coming through, will augur well for Indian IT, because about anywhere between 50 to as much as 75% of their revenues come just from North America. And because of that, it's likely that we will start seeing an improvement in earnings thereon in FY25. Of course, we're not going to consider what's happening in Q3 and Q4 because it's a bit early, and for all you know, the rate cuts may happen towards the end of the calendar year next year. That said, of course, all price movements are considering and factoring in what can happen in the future. But the real question is that among the top 5 companies, what would you bet on? And the suggestion at this moment is that while LTIMindtree is one of your top, of course now it's moved on, and it's become a top 5 in terms of market capitalization. The question really is that will it behave like a large cap? And to answer that, it's LTIMindtree is one of those companies which has a market capitalization of a large cap. In terms of growth, it in fact will behave like a mid-cap, because it will show about the expectation, of course, in this point in time is that the revenue growth could be around 13.3% against the average of around 8.8% for the other big four in the top five. And the other big four would include TCS, Infosys, HCL Technologies, along with Wipro. Of course, it has displaced Tech Mahindra in terms of market capitalization for now. And even in terms of EPS, in fact, it's twice as much as compared to the average of the other four. So 19% EPS growth is projected over the course of the next 2 years as compared to the other four, where the average comes to about 11%. And why is this growth coming through? Where is it coming through? This is largely on account of its high growth services, which includes accelerating client mining. We have strong sales efficiency, and of course there's a lot of cross-selling coming through, because of which we have seen that benefit coming for LTIMindtree. But the question is that is it reasonably priced at the moment? The most expensive of the top five coming in at around 29 times. This is FY24, but it's not significantly expensive as compared to something like a TCS, which also goes at around 26 times. And sure, you have Infi, HCL Tech and Wipro trading anywhere between around 18 times to 22 times. There isn't a very large gap, which is why at the moment there is a possibility that investors may still prefer LTIMindtree as compared to TCS.
So you've laid it out fantastically, Agam. I think what a few people will also be wondering is whether we've kind of jumped the gun on the earnings front, because all through the last quarter and after Q2, the point that was being made, and you made that point as well, Q3 and Q4, you don't expect there to be a change. Valuations, according to a lot of people, had bottomed out, but earnings had not. And we're talking about Q1 of next year. That remains to be the case?
Yes. So Alex, as far as valuations go, they're not as expensive as the rest of the markets. And at the moment, there seems to be a bit of a gap. And speaking to all the the analysts and traders and investors at the moment, they see that even if the benchmarks may have reached a bit of a top right now, there is some legs to the rally as far as IT is concerned.
18% is the gain so far in 2023, and quite a bit of that in just the last week, as you pointed out in the graphics that you put up on the screen as well. 7% in just the last week. Another stock that has gained tremendously in the last month or so, and still since the start of December, over 13%, and that's State Bank of India. It's catching up with quite a few of its peers in just that last month. But it's closest than it has been to the target price in all of this year, right?
That's right, Alex. So over the last 1 year, the target price has been hovering at about 711. And if you look at the Friday close, that's about 62 rupees short of reaching that target. What we pick up from analysts and the kind of conversation that the bank has been having, so over the last 1 month, the bank has been meeting analysts regularly, trying to convince them about where the bank is headed. Most of the analysts are pointing out that 2026, FY26 numbers are looking very, very strong for SBI. So they are
FY26,
that's 2 financial years later. So if you look at where SBI is at this point in time in terms of the stock movement, as you said, since December 1, it's about 13.1%. Since December last year, the stock's risen about 7%. That's adjusting for any kind of volatility that may have come in the interim period. If you look at the business side of State Bank of India, now that's where the interesting bit is, because they are guiding for a 15% credit growth for FY24. In a conversation that we had just last month with the SBI chairman, he was very clear that we are growing fast. 34 lakh crore loan book, so add 15% top of that, there's no other bank that comes even close to adding those amount of loans. Plus, of course, a lot of it is coming because there is a huge pile-up of corporate loans that is pending on the bank's book. These are loans that have been approved but yet to be dispersed, so those will keep adding
so it's
to the
not
portfolio.
Personal loans, it's corporate loans.
It's corporate loans entirely. So personal loans, if you look at what happened in the September quarter, the bank did cut down on the personal loan growth. It's still at about 17%, but it's lower than what the bank was growing at earlier. And that portfolio is only about 3 lakh odd crore. That's less than 10% of its total book. So they are very, very sorted on the loan growth front. SBI's asset quality, that's at 2.55% gross NPA ratio. That's I think in about a little less than a decade, that's the highest or the best asset quality that SBI has been reporting. You've got the bank's core fundamentals, credit code, deposit growth, and asset quality sorted. The economy is looking good. SBI chairman during our interview had pointed out that 15 lakh crore worth of capex was being lined up by corporates, and a lot of it will, will flow towards SBI because they will go to the largest bank in the system to fund that kind of growth. In his commentary, I did mention, I did ask him, why do you think that the market doesn't value SBI as well? I mean, even if you look at the way the price to book value has been shifting, you still don't find SBI anywhere close to where, say, an HDFC Bank or an ICICI Bank is, who are the pure banks, the only comparable
And
lenders.
the numbers are at 1.6 times as
1 point, yeah, so SBI is about 1.4, HDFC Bank is about 2.99, it's about roughly 3, and ICICI is, well, as 3.13. The point that he was making is that we are communicating everything that we know. We are unable to gauge what the market is missing. And if we figure that out, then our communication can be better. But then at this point in time, we are as clueless as you as to what the market is seeing, that the valuation is not rising as fast as it should.
Okay, so we'll have to wait and see what the print for Q3 is going to be. But if what you're saying is going to pan out, and will the loan book and the details of that loan book, the breakup of that loan book, will be critical to watch for.
Absolutely.
As well. And also, we're expecting to see a contraction in NIMs across the board heading into next year as well, right?
That's likely because you had lifetime high NIMs over the last 2 odd years, because deposit rates were at their lowest at that point in time. So now that is turning around, and credit growth, the loan growth, the loan interest rate rise on the loan side is capped more or less. Highly unlikely that you will see wide increase on the loan growth front, loan rate front. So that is going to add up into a narrower NIM for the banks.
So the big question is whether or not SBI should be getting a higher multiple. It is, of course, closer to its target price than it has been at any point in this year. What do you think? Let us know in the comments. And in the meanwhile, we have to slip into a very quick break. We'll be back on the other side with more before the start of trade, so do stay tuned.
watching the India market open. Let's take a quick look at the GIFT Nifty before we move ahead and look at what the top headlines are this morning. We're looking like a positive start, even after a cracker of a week and a cracker of a December. So you're looking at a decent gap up this morning. A quick look at the headlines. The stocks we're watching today, Z Entertainment, which has sought a deadline, an extension for its deadline with its Sony merger. Pharma firm Lupin, which has won new drug approvals from the US FDA, and Mazgaon for a new $42 million order. And sugar stocks are in focus as the government backtracks on the ban on use of sugarcane juice for ethanol production. ITC's largest promoter wants to cut stake, but the CEO of British American Tobacco says it's almost impossible. And the Finance Ministry rules out merger of PSU Bank, says the Parliamentary Committee is not empowered to do so. A host of IPOs have hit the market today. Muthoot Microfinance, Motisan Jewelers and Suraj Realty Developers launched their IPOs today. A total of 3,900 crore rupees worth of IPOs are being launched just this week. And let's go across to Agam now on the futures and options data. Agam, are you looking at a week of consolidation going further, or is there steam left?
Most likely consolidation, Tamanna, because we've seen that sharp up move, a lot of expectation of moderation towards the end of the week that really didn't come through, and in fact we closed near day's highs. So when it comes to our own markets, for now, of course, the Nifty well above the mark of 21,400 at the moment. We didn't see too much change in open interest as far as the index futures go, but Bank Nifty, on the other hand, did see in fact about a 5% increase in OI towards longs, even as the underlying advanced by around 0.9 of a percentage point. Now, as far as your option space is concerned, when it comes to the Nifty, for now we are looking at a lot of writing around puts, which would be somewhere around 21,100, 21,200, and I think we should move on to the next one because there is an error as far as this plate is concerned. But yeah, this is the one that I wanted to talk about, because we've seen a lot of writing around puts around 21,300 through 21,500, and that's where we are potentially likely to see some amount of support building in as well. And on the higher end, we're starting to see a lot of traders ride the 21,500 call, even though we're just 50 odd points away from there, and a lot more writing coming through as far as the 22,000 call is concerned. This is for this week's expiry, the 21st expiry, as well as the 28th December expiry. Let's talk about stocks quickly as well. We're looking at a bout of longs as far as Nalco and Oracle Financial Services go, and Nestle, ICICI Prudential, along with HDFC Life, looking at shorts building up. And in terms of those stocks which did see unwinding in trade, long unwinding in Max Financial, HDFC Bank and Dr. Reddy's, and SAIL and Hindustan Copper, on the other hand, see a little bit of short covering coming through. Sure, even though the benchmarks did advance substantially last Friday, the broader markets were, mixed. But let's take these cues and see what our market experts have to say. We have Milan Vaishnav of Gemstone Equities, who's joining us on the show right now. Milan, good morning and thank you for joining us. Let me start off with your view on the benchmarks and how are you placing your bets there?
Well, good morning, Agam. So far as looking at the options data in isolation, we all know that 21,500 call is building up OI, followed by 21,600 and has strikes. But at this point in time, I would like to take a little larger and a little more holistic view on the markets. There are no second doubts that we are in a very strong uptrend. We have some room left on the upside as well. But if we look at the overall structure of the markets, they are deeply overbought. But once again, as I say, being overbought is not an issue, because during strong uptrends, markets tend to stay overbought. But what is the worrying factor is the serious deviation of the markets from the mean. Now, even if you take a look at the weekly charts, we are now, and if you take the smallest, the shortest 20-week moving average, we are 1,700 points above that level. And if we take the 50-week MA, which is normally used to determine the primary the trend, we are, almost 2,500 points above 50 DMA. So what I'm trying to drive home a point is that despite some room being left from the markets, it's high time that we might see some consolidation or some measured or ranged retracement taking place in the markets. And in fact, if some consolidation takes place, which I feel is quite long overdue and imminent now, it will make the current surge a little more healthy than what it is today. So I feel that 21,500, 550 odd levels, 1,500 points here or there, but we are now in due for some serious consolidation on the markets. While coming to Bank Nifty, it has got some room on the upside. 48,500, it's where it can find resistance, and then in that index also we might see some consolidation. But by and large, I believe that near vertical move may not happen. If that happens, it's going to be extremely unhealthy for the markets, despite whatever macroeconomic reasons or underlying reasons that we may cite. But some consolidation in the market now looks imminent.
Right. So based on that, are you selling delta neutral strategies, Milan?
I'm once again going in for a short strangle, and not for this week, but for the monthly options, that is the ones expiring 28th of December. I would go on and sell 21,700 call at around 107 and 21,000 put at 43. So the total premium that we receive here is 160 rupees, and on the per lot basis, it would be 8,000. So that's the maximum profit that one can generate, and that would translate into a yield of around 7% from the capital that you will deploy. Now, the thing is that from a risk management point of view, we will need to close this trade if either of the edges, that is 21,700 or 21,000, gets violated, or we end up losing 2% of the capital. So keeping this very strict and vigilant risk management measures in view, I would like to go in for this short strangle in the first place.
Okay, fair enough, Milan. Let's talk about ITC then. This is where, once again, you're placing your bets as far as the options side. How are you playing it?
Again, I'm more taking a very classical look on the markets. I'm now going a little defensive when it comes to choosing the stocks. ITC is something which is now seen breaking out from a prolonged consolidation, and the relative strength against the broader markets now it has now started to improve. So ITC, I expect over next couple of days time, that is next 2-3 weeks time, I expect it to test 480, 485 levels. So I would be going in for a bull call spread on ITC. I would buy January 460 call and sell January 480 call and pay a net premium of around 7.5. So the maximum loss that we are looking here in this is 12,000, but the maximum profit potential stands here in the range of 20,000, 21,000 rupees. So stop loss, rather than waiting for this maximum loss figure to occur, we can maintain a stop loss of ITC spot prices slipping below 450 levels. So that way we can well manage the risk even with the lesser amount of what against what is mentioned in the maximum loss figure. So by and large, I expect ITC to test 480 by next month or maybe later this month. So this is my bull call spread for ITC.
Okay, so that's your debit spread on ITC with a maximum profit of 20 points against a maximum loss of around 12 points, thereabouts. Milan, thank you so much for joining us and taking us through your views on the markets and also giving us the kind of strategies that you are deploying at the moment. And on that note, I will handing it back to you, Tamanna.
Thank you for that, Agam, and we'll start with our setup for the day, what you should do, and go to our experts in just a sec. But I just wanted to highlight one more story that has an important clarification coming in, and this is on PSU bank mergers. And Samina, this is interesting because the way one post on social media became a huge, viral kind of piece of news, so-called news over the weekend, and it's important for that clarification and just to mention it over here. It was just a screenshot of a secretary's address to a parliamentary committee who is meeting with bankers. The subject mentioned on merger. but then they have come back and clarified, and that's also highlighting how important it is to get the right source of news.
And social media,
yes.
The importance and power of social media as well. Of course, talking about that, you may see some activity on those counters while the clarification, like Tamanna said, has been put out and made very clear by the ministry. The four stocks that were talked about on social media was Union Bank and UCO Bank, the merger there, and Bank of India and Bank of Maharashtra. So these are counters that may see some bit of volume activity in today's day of trade. Well, we have with us Parthiv Shah and Kunal Ramba, both joining us for a fundamental and technical view on the markets. Thank you, gentlemen. Good having you both on the show. Kunal, I'm going to come to you first. The markets have been on a roll for the last 7 weeks, not just locally but globally as well. The Nifty IT index was a shining star over the last 2 trading days. Metals not too far behind. Bank Nifty has achieved levels of 48,000. But let's start with the benchmark first. Which is the next stop on the index? Are you expecting today to be a bit of a day of consolidation? And if we do see some weakness, would or could traders initiate long positions?
Very good morning to everyone. Thank you so much for having me on the show. So if you look at the indices, yes, we have seen a massive rally on the indices. If I talk about the Nifty, it has gone up by almost 2,500 points in 35 trading sessions. And if as far as the Bank Nifty is concerned, I think we saw the rally of almost like 6,000 points in just last 35 trading sessions again. So yes, that's a massive rally, too much of the upside being done. That's what everyone is talking about. But as of now, if I look at the indices charts, it's trading at all-time high and the sky is the limit for this. So just to put a ballpark figure on this, I think on the Nifty front, 41,550 to 600 kind of levels are something to watch out for the resistance. Now, again, the strength is really so very high that we'll have to wait and see how the markets pan out for the next, 10 to 15 days, because we're heading for the monthly expiry also. But yeah, something like 21,600 kind of levels to watch out as the first resistance. And immediately on the support level, we have around 21,300 kind of levels as the immediate support on the Nifty.
All right. Good morning, Parthiv and Kunal. Tamanna here. Great to have you on the show on NDTV Profit. Parthiv, let me just begin with what kind of a strategy you would look at for this week. Are you focusing more on consolidation, or are you hoping to sort of see the upbeat mood continue? Will you be sitting on the sidelines this week?
Good morning, Tamanna, Samina, all our panelists and viewers. Thank you for having me on the show. Very frankly speaking, our markets have done extremely well, thanks to the fact that, we've been getting good amount of flows from the FPIs. They've been net buyers to the tune of almost 43,000 crore. And yet the ownership of the FIs is still at around 18%, which is at a 10-year sort of a level, which is kind of low because historically we've seen them go past 21%. So I believe that there's still that liquidity chasing our markets. A lot of private sector banks are still under-owned. So despite the fact there's a lot of chatter that, the markets have run up a lot and there could be some consolidation and a lot of correction, our sense is that we are still quoting at around 20 times forward, which no doubt on historical standards is little priced to perfection. But thanks to the fact that we have a lot of earnings growth, which is to the tune of around 15 to 18%, which is quite visible in the market. A lot of chatter regarding the Fed talking about, the inflation kind of peaking out, and next year probably they're talking about easing the rates. So I think there's going to be a lot of liquidity. No doubt in a bull market, there is always a possibility of a healthy 5-10% correction. But our communication to our clients is that hold on to your positions and try and kind of restructure your portfolio from more of the mid caps, small caps, which are looking a little pricey out here, into more of the quality names, which are the large caps, because at the end of the day, we are concerned with generating alpha. And our sense is over the next 1 year, there'll be more alpha created in the large caps vis-a-vis the mid and the small caps.
Right. Where are those opportunities? We're going to ask our experts about that as well. But just to hold on for a second, I want to go across to my colleague Anushi Vakharia, who's talking about all the buzzing stocks this morning with a lot of news flow coming in. Anushi.
Morning, Tamanna. Quite a bouquet of stocks that we have today. First is the Zee-Sony merger, which everyone is talking about, wherein Zee has requested Sony India to extend the timeline for the merger. This is the first out of the 3 extensions allowed. Now, apart from this, even Sasha Mirchandani and Vivek Mehra failed to get requisite majority of votes for being reappointed as the independent directors of the company. But what is more important is the Elara's note on Z, wherein it is positive on the company and implied about a 23% upside. So with this, the company expects the extension of merger timeline is a positive, and they are also seeing a high likelihood of the company going through with merger without Mr. Puneet unless SEBI outcome is in his favor. With this, the Elara expects the merged company to be listed by March or April of 2024. Moving from this, we have Welspun Corporation's recent acquisition, which is the Sensex brand that is going to invest up to rupees 807 crores over the course of 3 years for setting up a manufacturing facility in Telangana. This is to mainly produce the water storage tanks and plastic pipes. So plastic pipes is the new foray that the company is making, wherein they are seeing about 10 to 12% CAGR growth. So definitely a watch out for this one. Now we have Mazgaon Dock, which has received an order worth $42 million from its European client for construction of 3 vessels. If you look at the company's order book in the second quarter end, that was about 37,500 crores. And this is in line with the company's guideline of reporting about 12 to 15% increase in that top line compared to the last fiscal, which is FY23. Lastly, the newly listed Gandhar Oil Refineries Q2 FY24 results came out. So the company had a stellar listing debut of about 66x subscription and a listing gain of about 76%. But if you look at the Q2 FY24 results, the key operating metrics, which is your revenue margins and net profits, all three saw a bit of a drag, with your EBITDA margins being down about 27 bips due to higher raw material cost. So we should see some impact on this one today. So yes, these are my stocks to watch for today.
Thank you for that. Lots of independent stocks that will be in focus this morning. We'll talk about those with our guest as well. But Kunal, I have to start by asking you this. What are you doing on Nifty IT? The index is up 7.5% in the last 2 days. Usually those are the kind of gains we see on an index over a period of time, like a month or maybe even longer. Would you go long on the IT index today if you see a gap down?
So again, if I look at the risk reward ratio, it's very unfavorable as of now, because in the last 2 days itself, if you look at the index, it's gone up by almost 7.5 to 8%. Now at this level, initiating new longs on the index will be a little risky. Instead, we can look at the individual pockets, like say Wipro, which has given a fresh breakout, or say Emphasis, which has again given a fresh breakout. So I'll go stock specific rather than going on the index. So on the Wipro, if someone wants to take up the trade, I think the fresh breakout was seen on the chart at around 445. With the stop loss of 435, one can definitely buy on this, and I think the position levels of as high as 475 to 480 can be the first target on the chart.
I just want to get picks over here from Kunal as well on what you're liking this morning. I believe SBI Cards is on your list, and what do you find exciting over there, Kunal?
So the interesting observation on the SBI card is that this counter has not really performed in the entire rally. And if you look at the extreme lows of the counter in last 2 years, the counter has always made the bottom at around 750 kind of levels, 725, 750. And from there itself, it has always begun a rally. Now on the chart right now, this counter made a bottom at around 735, 740 in the recent past. Right now it's trading at 775 and it's gaining momentum now. So with this, I think one can initiate a buy on this with the favorable risk reward ratio. The stop loss on this can be 750 and the first target on this can be 825.
Right. Kunal and Parthiv, stay with us. A quick check on getting a trade this morning. We'll come back, we'll take a break, we'll come back and talk to you about pre-open trade. It looks like it's going to be a quiet start. Remember, global cues are also fairly flat. It could be a morning of consolidation, but stay tuned, we'll be right back. back. You're watching India Market Open. A minute to go as we gear up for trade this morning. Parthiv, what are you doing with IT stocks? Any of those mid-cap, large-cap IT names that you would buy?
Yes, IT has done extremely well of late, despite the fact that most of the consensus commentary from the managements is talking about a lot of headwinds yet. No doubt some of the companies have improved on in terms of the deal pipelines, but yet the execution is lacking. So our sense is to be a little cautious on the entire IT pack, especially one should wait out for the Q3, Q4 numbers and then take a call, because still there are a lot of structural headwinds coming from the US and the European markets. But nonetheless, I think amongst the mid-cap IT space, I think there are some interesting bets where I think they are defying the gravity and doing extremely well in terms of mining of their clients. And one of the stock that we like is L&T Technologies. Again, I think there's a lot of work happening in the ER&D space. And this is a company which has mined extremely well, a lot of good clients, and they're scaling up, increasing their wallet share. So despite the fact that it's a little pricey in terms of the forward multiples, but again, looking at a structural growth story out here, we find a lot of comfort adding this to the portfolio.
Absolutely. I own tech stocks this morning. Definitely I own whether the banking buzz is continuing. Lots of stock-specific news coming in. But let's take a look at pre-open rates on the markets today. And these are just initial rates. We'll see how they settle down. So a conflicting view there between the Nifty and the Sensex, largely looking like it's up in the green. But we'll wait and see. We'll wait and see whether this is a week, a day of consolidation, whether we're going to see further run-ups, and whether the broader indices are going to participate at all. An overwhelming portion of the commentary is about how now the focus moves to large caps, and do we see that playing out? So we'll revisit those opening rates in just a couple of minutes and see how they're faring and where the settling is looking like. But so far, positive on the Nifty. Before we move back to Parthiv and Kunal, we also have an eye on Indian Bank as it raises a 4,000 crore rupee QIP. A lot of other stocks that we want to talk about this morning. So let me go across to Mahima, who has all those details.
Right, Tamanna. So as you rightly mentioned, Indian Bank has raised 4,000 crores via QIP. If you see the number of shares that were issued stand at 10.15 crores, and they were issued at 394 per piece. And these shares were raised at a discount of 4.9%. If we talk about the stock performance of Indian Bank, the stock has gained over 60% in the past 6 months. Next, we have Tata Power, where the company has signed pacts with NTPC to provide solar modules to NTPC in Rajasthan. The project value stands at 418 crores, and if you see, Tata Power has been collaborating with IOCL also to deploy over 500 plus fast and ultra-fast EV charging stations across India. The solar EPC book for Tata Power at present stands at 18,700 crores, which is a very strong number. If we talk about the stock performance of Tata Power, the stock has been up over 54% in the past 52 weeks, and the stock is up over 50% in past 6 months itself. And lastly, we have NBCC, where the company has conducted an auction for sale of 2.23 lakh square feet of World Trade Center in New Delhi, and they acted as a marketing consultant for Ministry of Housing and Urban Affairs to conduct this auction. The sold commercial inventory was of worth rupees 905 crore, where total sales through e-auction stood at 9,656 crores. Recently, they've also received an order of construction of 1,469 warehouses. If we talk about the stock performance, the stock has been up over 99% in the past 52 weeks, and the stock is up over 36% in the past 3 months. So these are 3 important stocks to watch out for in today's trade.
Absolutely. Parthiv, I just want to come to you as we head into the pre-open session on any specific sectors and stocks that you're looking at this morning beyond now the tech play.
Oh yes, we are very upbeat on select private sector banks, especially Kotak Mahindra Bank. If you see what this company has reported last quarter, in terms of PAT, they're at a run rate of around 4,400 crore. ROAs have inched up, gone to around 2.68%, which is extremely healthy for such a large size bank. The ROEs are almost at 15%. The customer assets have inched up hugely. They're sitting at around 4.28 lakh crore. Kotak Mahindra Bank is having a market cap of around 3.5 1.5 lakh crore. In terms of the book value, that is at around 606, which gives it a 3 price to book multiple. If you see on a historical basis, I think this is one of the lowest price to book multiple for Kotak Mahindra Bank. No doubt, probably the markets did find some headwinds in terms of the change in the management, but I feel that is now done and dusted. Going ahead, this is one bank which I feel in the private sector space can very safely create a lot of shareholder value out here.
Right. Well, a quick check on the dollar-rupee pair as well. Remember, the rupee gained strength significantly on Friday on back of a number of Indian corporates raising funds outside. That led to custodian banks bringing in enormous amount of dollar, which of course pushed up the rupee quite significantly on Friday's day of trade. The strength on the local currency continues, and today is about rupee strength as opposed to dollar weakness. We continue to trade sub 83. We closed at 83 in trade on Friday, this morning at 82.97. It also could be a function of stop losses getting triggered in the currency markets. Of course, we'll understand more very shortly as we try and connect with somebody on the show. Well, Kunal, I want to, as we're gearing up for trade, it is looking like a quiet start, but I want to quickly try and get your stock picks from you this morning. Anything on the long or short side?
So the counter which I'm looking now is the India Bulls Housing Finance. The only reason being this counter was in band, but now it's coming out of band today. And if you look at the overall structure of this counter, it is clearly making a higher top, higher bottom formation, and there is a lot of room for the upside even from the present level. So I think one can initiate a buy on this counter. The stop loss on this can be 215 for the short-term traders and 210 for a positional trader, and with the target can be as high as 250. And just one point is that this counter is coming out of derivative this month end. So one can actually go long on the cash segment rather than going for derivative trading. I think 250 is the first target to watch out for.
Well, any view on your large tech pack, TCS, Infi, etc., runaway successes, HCL Tech, runaway successes on Friday trade and last week? Do you think that they've hit resistance levels? Do you expect to see a bit of profit booking there?
See, more or less, we saw the underperformance of this entire large cap pack in the past, right? So the first move which we saw was a massive move on the Friday itself. I think there is still little more room for the upside when it comes to the large caps. But the best counter which I personally feel based on the technical formations is TCS. Even at the present level, it's looking very attractive. One can think of buying on decline. The support level on the chart is now at 3750, which is almost 100 points away from the present level. But I think one can initiate a buy with that particular level as a stop loss, or try to buy near to that support level itself. And the first target on this can be 4,000. Probably even higher, but yeah, conservatively we can place this target as a 4,000. I think this counter seems pretty good based on the technical formation.
Parthiv, metals have also been in focus over the last couple of weeks now. There has been expectation of stimulus coming in from China. I know it's not happened yet, but it's kept the sector quite active. And of course, more importantly, dollar index sub 102 is another big positive for commodities. What does that mean for metal names, and which metal stock looks attractive to you for the next couple of months, or from a short to medium term outlook, really?
Yes, I think if you see the global trend, especially in the ferrous and the non-ferrous space, you see the price of iron ore. I think despite all the headwinds coming from China and the Chinese property markets, I think iron ore is continuously inching up. What's been happening is a lot of Indian iron ore is now looking at exports. So as a result of which, we are expecting the domestic iron ore prices to go up, but the steel prices had come off by at least 15%. So we are expecting a lot of steel companies to raise the prices, and especially the companies having backward integration capability of iron ore, names like SAIL, Tata Steel, should do extremely well. We are quite upbeat here. And in terms of the non-ferrous space, I think we feel names like Hindalco, which are low-cost producers, should do extremely well. Not only the fact that there's a lot of global demand, but I think they do have some scope for exports as well. So I think these are the three pockets in the metal space where we are upbeat on.
Parthiv, I just want your take on the sugar pack, and we had a sort of a clawback on policy which came in, that clarification which came in on Friday. The actual notification still needs to be put out. So I'm sure the industry will wait for those details coming in, but largely relief from any kind of ban on use of B-grade molasses or sugarcane. How do you see the reaction in today? Because it was already baked in that there would be some positive response from the government.
Yes, absolutely. I think probably the market is aware of the fact that these could be more of temporary measures because of the shortage in supply of sugar, not only in India but globally as well, because of the seasonal weakness coming from Brazil. But our sense is that these companies are in a lot better shape. The cyclicality element has reduced a lot because if at all the sugar supply were to increase, I think the government will be more accommodative in allowing them to blend a lot of more ethanol. And a lot of these companies have already done capex in terms of generating more of the ethanol, and going ahead that is going to help these companies to have a very good balance sheet. But again, I think to play this sector well, it's better to go with the frontline names. We are more upbeat on names like EID, Perry and Balrampur Chini, which have the scale and the might and the balance sheet strength, I think, to kind of mitigate all sorts of cyclicality in this sector. And people like Balrampur Chini have also done a lot of buybacks, which is a very rare in a cyclical sector. So these are two counters I think I would suggest investors to park their funds into for a long horizon.
Right, that is the verdict coming in on the sugar sector. Well, it is expected to be a flat start, at least that's what we're picking up in pre-open trade. We will take a quick break, we'll come back, continue talking to our guest and also gear up for market opening, so stay tuned.
Less than 2 minutes to go for market opening, and we're looking like a flat start this morning as per pre-open trades. Will broader markets, will the broader indices show more signs of life? Will it be a more stock-specific kind of a story? Will sugar shine? Will we have the IT sector showing that kind of strength? Quick last word from Parthiv and Kunal before we go to the opening. Parthiv, first I'll come to you. What is your top pick, one top pick at this point?
See, we like Reliance Industries kind of has not participated in the rally, and all the verticals for Reliance, I believe, especially O2C, should see turnaround going ahead. Also, the retail division is gaining in a lot of traction. Jio, they have revised some prepaid tariffs, which shows they are moving more towards premiumization. And again, the buzz on their gigafactories, especially focusing on the new energy vertical, is exciting. So going ahead, I think Reliance can be an outperformer.
Kunal, top quick pick from you before we go into opening.
So at this point in time, I think I'll go ahead with the Indus Tower. Indus Tower is looking very attractive, and it's in fact a gap up opening. Just last 2 to 3 trading sessions also, if you can see the behavior, this counter was clearly making higher top, higher bottom, and it is given a fresh breakout at around 195. So I think with this today's gap up also, I think I'll go long on Indus Tower. I'll place the stop loss at around 190, and the first target which we can expect on this going forward can be 210 and followed by 215.
Right, Kunal, Parthiv, stay with us. We've got 15 seconds to go as we are gearing up for this week's trade. It is going to be a flat start, so don't expect fireworks in early minutes of trade. We've had a very solid run for the last few weeks. The benchmark itself may see some consolidation and a negative start. Your Nifty 50 is marginally lower, 0.25% down on the Nifty 50, 21,400 odd is what we are trading. And Bank Nifty is leading the way down to 0.5% cut. So underperformance is across the broader markets and sector specific. Remember on Friday what we saw was the broader markets didn't do as well as the Nifty itself. So what you're really getting in this morning is a similar sort of performance playing out, but the broader markets aren't doing too badly in terms of trade. Small cap index surprisingly trades with a marginal positive bias. Could be a reason that sugar stocks, which are largely across the broader markets, could be providing some support to the markets. The Sensex is off 0.5%. Nifty 50 below 21,400. 21,370 is what we have, 0.5% cut, keeping in line with most of our Asian peers as well. Across the Nifty movers, the breadth will be weak. Remember, the bias will be towards the declining stocks as opposed to the gainers. Very few gainers in terms of today's trade. You've only got about 10-12 counters that are trading marginally positive. The rest of the Nifty 50 is trading lower. I'll start with the losers. Metals are taking some profit off the table. So JSW Steel is out 3-odd%. Hindalco is trading weaker. You've also got IT counters. So all your big gainers from last week are witnessing profit taking in early hours of trade. Tech Mahindra, HDFC Life, Tata Steel, SPI, ITC, ICICI, M&M. So banking, metals and IT is what is seeing weakness. On the gaining side, it's defensives. Those are looking pretty decently placed. The likes of Titan, Bajaj Finserv, pharmaceutical names are looking okay. And auto is seeing a little bit of buying. So Aisha and Bajaj Auto are both trading with a gain of 1.5%. But Tamanna, it is a quiet morning. It's a day of profit taking. No surprises there. We've had such a solid run over the last few weeks, and the counters that are leading the profit taking are the biggest gainers from last week.
Absolutely, and we are going to see that kind of a December mood now slowing down, which will be seen in this last couple of weeks, last few trading sessions of the 2023 year. Let's look at what's happening stock specific, and one of the big news stories coming in was the relief to sugar companies. I want to start with the sugar pack and see what's happening there. And there you see real sweetness coming in on the sugar pack. Dwarikesh, Balrampur, Chini, Shri, Renuka. Let's pick up EID, Parry. All of the other sugar companies which are seeing Rana Sugar, all of them seeing a pretty good start. So definitely there has been relief there. We spoke with Mr. Manikam early this morning, who was saying that the big relief, of course, will come come when the government goes out of ethanol completely. But yes, for now, sugar is definitely leading the pack today. I want to look at some stock-specific stories when news has come in. Edelweiss had news coming in just a short while before opening. They commenced their planned stake sale of 10 to 20% in their arm. The procedure will be completed within 4 to 5 months, and they want to raise 1,500 to 2,000 crores through this planned stake sale. The market's not responded too positively. Nuvama, meanwhile, will be exploring all legal options on the SAT order. So you have that story coming in. Z, let's talk about Z Entertainment. An extension of deadline has been sought. The stock about 4% down. So that merger with Sony is now being pushed even further. Behind the scenes, are they deciding on who will run the merged entity and where will that end? So while the suspense continues, the stock responding negatively. Solar Industries is another one with negative news flow. 6.5% down on that stock. There was an explosion incident at their Nagpur factory. Very unfortunate incident. 9 workmen were killed, and there will be an investigation into the causes as well. Lupin. Let's look at some of the pharma pack, because 3 stories or news pieces from the pharma space. So Lupin, Zydus and Granules. I'll go through all of them. Lupin has received a US FDA approval for its ANDA application on 2 formulations. That's up 2.5% up. Zydus has also received a final US FDA approval for a tablet used for partial onset seizures. That's about 2% up. Granules, India's Virginia arm, gets a 5 observations, so negative over there for Granules from the US FDA post an inspection. Just Ambuja Cement is one that I will add this morning. They will be powering 60% of production with green power. They're planning 1,000 megawatts renewable energy at an investment of 6,000 crores via internal accruals. You know, this is a broader story emerging where a lot of old economy infra companies have set very solid targets of now powering their businesses with green energy, and that's definitely one to watch out for. That stock is up. I just want to talk about the JSW pack, JSW Steel, JSW Energy. There's been negative news flow over the weekend, a clarification coming in from management, the top management, on serious allegations being made in an FIR, and you're seeing a spot of weakness there in the entire JSW pack. So those are broadly the big movers and shakers in the first few minutes of trade. But Samina, anything else on your radar this morning?
It's not a good-looking picture this morning, but I don't think there's any disappointment on the street, because this consolidation was much awaited. The Nifty is trading weaker. Bank Nifty, Metals, ID. So all sectoral indices are trading in the red, but like Tamanna indicated, the morning belongs to sugar players. So your likes of Balrampur, Chini, Dwarikesh, Sri Renuka are all trading deeply in the grid. So a little bit of support coming in for the small cap index is largely on back of what you are seeing across sugar players. Lupin is seeing some gains, 2% higher on Lupin. You've got telecom like Idea, that's not looking too bad. Petronet, I also want to look at Praj Industries. Can we pull up Praj? Praj, remember, supplied the technology for ethanol for the sugar companies. The stock is reacting really well, actually. 6.5% higher on Praj is what we have. Key beneficiary, remember, in the ethanol play for support. So ancillary to the sugar sector, the counter is trading with a gain of 6%. On the losing side, I'll quickly mention a few names that are under pressure. So Z, like Tamanna indicated, is continuing to see pressure down about 4%. NMDC is down 2%. M&M Finance, Emphasis, PFC, LIC Housing, Bharat Forge, Federal Bank are all trading with a cut of anywhere between 2 to 3% each. So the breadth is weak. The broader markets are seeing a little bit of weakness. Barring sugar, all other sectors are trading in the red. Kunal, what are you doing on the index? We've got a pretty decent cut this morning, and I'm sure there's enough and more money waiting on the sidelines to jump in. Would you consider initiating fresh longs at this point on the Nifty, or you'd still wait?
So I think at this point in time on the indices, I will not be really keen to buy or sell. Reason being, we have already seen a heated rally, right? So this consolidation or correction might just get extended. So on the Bank Nifty front, I'm looking out for the levels of around 47,800 on the futures part. And on the Nifty, it's going to be 21,400 levels. So once these levels, come nearby, I'll think of going long, because the trend is still positive. But at this point in time, I will not be keen to either go long or the short on the indices. But yeah, stock-specific movements can always continue.
Right. Thank you, Kunal and Parthiv, for joining us this morning. It is a quiet Monday morning on Dalal Street. Well, we have Ajay Srivastava, MD of Dimensions Consulting, joining. Ajay, good morning. This is Samina. It's been a while since we last spoke. But coming on the markets, the last 7 weeks have been a very strong run for the markets, not just locally but globally as well. Any risky asset has done well. So be it the way the dollar index is played out, be it commodities, the strength on the local currency, the Nifty itself. How does it look for you? What do you think? The markets have some more steam left, or it's now time to take some profit off the table?
Good morning, Samina. Good to have back with you. I think the market is telling us a good story is it's a holiday season. Just take your profits, put either you bank it or you leave it in the portfolio, go have a wonderful Christmas, New Year holiday and come back. No matter what you do at this point of time. If you buy, you're going to have a remorse because you're buying really at the highs. If you sell, you'll wonder next year why you did the same. So, you are investors and all of us in a kind of a flux to say, what do we do next? We made all of portfolios are really fantastically in the green, but having said that, I think the only exercise we are telling our teams to do is to now look at the laggards who have not performed in the portfolios and see, is there a compelling reason for them to be kept in the portfolio for 24, or we just go back and strengthen what has done well in the portfolio. So I think barring that activity, I think it's a good idea to spend some money on the holidays and not to take large positions in a situation we are in. It's been a happy market at this point of time. Why do you want to complicate your life by having positions in the last 1 week or 2 weeks? Which kind of give you stress. So I would say just take out the laggards out of the portfolio whom we think is not going to do well, leave the portfolio as it is, book some profits, take a holiday, come back in 2024 and life will look a lot better.
Ajay, now that is very pertinent information or opinion for traders. Now, what do retail investors do at this point, right? You have STPs or SIPs that retail investors are doing month on month. The Nifty itself, if you look at any of those returns, any sort of mutual fund portfolio for that matter, has done a return of 18 to 20%, even if it is just large cap. Do you continue investing into the markets in a staggered manner? Do you stay on the sidelines for the next couple of months? I'm just struggling to get my head around what is the approach one should be adopting if you're not a trader.
I think it's a simple thing. It depends upon a time perspective. If you need the money next year for your son's education or your daughter's marriage or some other house commitments, then you got to be a little more careful where you're investing your money. If your thinking that, listen, it's a 5-year, 7-year, 10-year time frame, I'm planning for a 10-year future, then it really doesn't matter actually. The index doesn't matter, the timing doesn't matter. And number two is, most likely, if you do not put the money in the market, you're going to spend your money. I think if you're a youngster, I was once upon a time, it was any money in the bank was worth a spend. So I think the critical question to everybody is, what's your time frame? Because if you have got a time frame of 1 year, 1.5 years, I would still say that the debt investment, the gilt investment could give a decent return to you without any of the issues of the market upheavals or movement. So I think if you're a short term, I would stay away. If you've got a perspective of 3-5 years, friends, there's no reason to doubt the trend at this point of time. And if the political developments are what they are in India in the next year or so, and with the oil prices where they are, the rupee has appreciated, interest rates have peaked out, there's no reason to stop your investment from a longer term perspective. But from a short term perspective, markets do run up, markets do correct. So I would say for short term, gilt is a better option at this point of time. For people longer term perspective, don't need to change your portfolio choices if they're doing well at this point of time. The question is, did you choose correctly? And if you've not chosen correctly, this is the time to correct yourself, to go back in the sectors you did not invest in. If you've not been in capital goods, time to go in. If you've not been in defense, time to go in. If you're not in hotels, time to go in. Not in aviation, time to go in. So I think you need to do a lot of portfolio correction. This market gives you opportunity. And most important, I mean, I'm repeating what I said. This is the kind of market which lets you get out of a lot of ugly stocks. And you got to be very, very precise in that, listen, I need to book and get out of those stocks, because if they're not going to perform, they might even fall. So and particularly small caps, I think prune your portfolio is all I can say at this point of time. This gives a brilliant opportunity to get out, prune your portfolio of small caps if you have direct investments.
Good morning, Ajay. This is Tamanna here. Absolute pleasure to speak with you this morning. You know, now for those of us who are not going to get holidays, there's no point booking the profits, but that's on a lighter note. I want to follow up on what you said. This is time for a cleanup of your portfolio, especially with perhaps small cap stocks which have run up massively. Anything more specific that you can add? Valuations or run-ups that you found did not really perhaps merit it?
See, small cap portfolios are there. I have lots of stocks sitting there which have got P's are now even exceeding 70, 80 and 100. And I think that's the ridiculous P one would like to pay for a small cap stock, particularly when the growth is not going to be more than 8 to 10% of most companies. So if you look at the map, the index there are about 500 companies which have not grown, but the P is now above 50 in our analysis that we've done. We can't name it for obvious reasons, but I can tell you that many number of stocks have run up with no fundamentals. And I think we need to be careful as to say why we are invested in the stock. I'm talking of 500 such stocks exist in the universe today. So that's one. Number two is, as logically as can happen, some of the sectors also will not perform compared to the market. Let's take pharma, for example. It's done a decent job once in 5 years. It's like, I don't know, I can't name the flower which comes up in Himalayas once in 80 years or so, but I think pharma is like that. Once in 5 years it blooms, and then for next 5 years, investors take a hit on that one. Pharma is another sector where you want to be careful as to why you are sitting there at this point of time, because lots of run-up has happened. Few companies are going to do well. The rest are going to be laggards. And one thing is very clear, government policy. You saw the up and down with the sugar. You may see a major upside if there is an anti-dumping duty on steel. If it doesn't happen, the steel stocks are going to lag. So keep a close eye on government policies. Look at the refining companies. If there's a steep price cut coming into the election, we don't think it will happen, but should it happen, that fortune will kind of take upheaval. So today, if you ask me, the market risk is now becoming what has happened to the government policy. And I think anybody who owns sugar stock would testify to that. So I would say 500 small caps out of it. Government policy stocks, be careful how much you're committing to it. And if you're not in the sectors that are going to do well in the next 3 years, which is particularly going to be infrastructure and defense and high-end consumption items, I think you can just reallocate your portfolio there and sleep peacefully. And I'm not being lightfully about holidays. Sometimes it is good not to do anything. And sometimes it is also good to spend the money you earn. Otherwise, you see it coming and you see it going in the market and you wonder what you could have done with further time.
No, that's a very, very important lesson, Ajay, absolutely. I just want to get your take on the large cap narrative that now what we're going to see in 2024 and the beginning of 2024 is a revisit and a re-evaluation of large caps. Within this, is there anything that you particularly like? And do you concur with that outlook that now it is going to be the turn of large caps to fire?
See, I don't know this philosophy of this will fire, that will not fire. Because the large caps will fire, I can promise you the mid caps will fire equally well, because there are lots of mid cap companies heading into the large cap universe. But I am of the firm belief that you cannot build a portfolio in India without being part of some large stories at this point of time. No matter it's a banking sector, no matter it is a retail sector, whichever sector you choose, you've got to have a few things. And third, more important, is the IT sector. IT sector actually gives you opportunities to come into the sector many times over the period of time. And most investors miss it, saying, it's not this thing. But overall, if you see the returns in the last 5-7 years, IT has been a pretty consistent giver of return, give or take a few years. And the kind of dividends and the kind of buybacks they give you, it's unprecedented as a sector. No equity dilution and do it. So large caps, answer would be that they have to be always part of a portfolio. I would wonder how could anybody think of a portfolio without having any large cap and only mid cap and small cap. Now that's serious amount of risk on the table, and these large caps are not going to disappear. They're going to do well. They may not perform all the time, but in a longer term perspective, I think they do good to your portfolio at this point of time. So, having said that, the question is, take your risk appetite, what's your proportion? I do not believe for a minute that 2024 large caps will outperform the mid cap story. I do not believe it, because of the simple reason I do not believe it is that the larger amount of volume flows go into the mid cap stocks. The larger growth story are coming up there. When you look at the capital expenditure of large cap stocks, leave aside Reliance out of the picture, it's not a very happy picture. They're not spending any big money on growth capital. You look at the mid cap compared to capex versus their net book value of the fixed assets, the growth is phenomenal, and that may take a year or two to come through, but it'll come through. So growth trajectory wise, one can be very clearly see mid caps are spending a lot more on capacity and growth compared to the large caps. Logically, mid cap should do better than large cap. So yes, they should be part of the portfolio, but I do not subscribe to the theory that they will outperform the mid cap in 2024.
Right. Ajay, you know, in your recent interview that you had done a few months ago, you had said that new age sectors and companies are the way forward for investors chasing high returns. How do you feel about this, and what sectors are you specifically talking about? Is it, and companies, are you talking with the likes of a Nykaa, a Zomato? Is that new age in your definition, or would financial ancillaries be a new age sector?
I think both, if you ask me, are new age sectors. And you know what better proof than what happened in the political landscape? Listen, what did the old foggies do? Lose the election for the Congress, right? And what's the winning party has done? Brought in new guys on the block into the chieftain slot. It's the same, it's a law of nature that we have to retire and we have to go to the new at the end of the day. If you don't follow law of nature, I think you are meant to suffer. You know, the point, these companies luckily are in sectors where there is no legacy large company existing. Large companies are trying to find a way in, like Reliance is trying to find a way into retail, but it's not find easy. DNAs don't happen overnight. So these companies represent, I'm not saying recommending investment, but I'm saying as a thesis, these companies come into the sector where there's a new methodology to deliver the product to the customer, distribution, satisfaction, including financial closure of, fintech transaction. Who thought these banks were sitting on the side and pay and borrow money, which is done by the fintechs, has taken the market by the storm at the end of the day. Sure, banks got an indirect benefit by being lending to NBFCs, but they were not on the cutting edge of lending to the consumers. As you buy your groceries, you can pay an EMI. It's incredible, absolutely. So, so therefore, I would keep saying that your portfolio, and this is, and like companies do it all the time, consumer companies do it all the time, should keep having increasing proportion of companies which have come into existence in the last 5 years. Sectors which were not true. You saw the airline lounge company. It came from nowhere and as a phenomenal return. You saw the watch distribution company. We didn't have these companies in the country. But when it came, the returns to investors were phenomenal. So I would firmly believe that if you have a portfolio built up not less than 25-30% of companies which have come into the market in 3 years, I think you're doing disservice to your long-term, to your portfolio. Yes, cement will do well. Steel may still do well, but that's legacy. They cannot outperform the companies which are now aiming for a market share in a country of 1.3 billion. Let's say food delivery. Food delivery is still a very urban phenomenon. Can you imagine that this company what it would look like 5 years from now if it straddles 500 million customers, advertising revenues, delivery revenues? Just think of it and your mind boggles you. The game is just beginning here. In a cement, you are basically going to add capacity, capex, then fight in the market. These companies, no competition or very limited competition, unlimited market share, and therefore if your portfolio doesn't have it, I think you will be slated for disappointment in the next 3 years.
Yeah, absolutely. Thank you so much, Ajay, for speaking with us. Absolute pleasure to have you on, and hope to speak to you very soon. Once again on NDTV Profit. Now let me quickly go across to Atul Chaturvedi, Executive Chairman at Sri Renuka Sugars. He's with us on the show. I'm also speaking with Praful Vitlani, Founder, Chairman of the All India Sugar Trade Association. We're trying to get a quick sense of how positive these developments are, the government's sort of relaxation on rules for ethanol blending. We've seen the sugar pack completely soar this morning, and we'll get some of those companies on together. Mr. Chaturvedi, very good morning. Tamanna here. Thank you for speaking with us on NDTV Profit. Is this enough of a relief, considering that there is an overall cap of 17 lakh tons? But in the near term, what does this mean for sugar companies that you've been allowed to use sugarcane juice as well as B-grade molasses for ethanol blending?
A very good morning to you. In fact, when the ban came, it came as a sledgehammer. So sugar companies who were making ethanol out of cane juice were taken in for a big surprise. And now this reconsideration of allowing about 1.7 million tons of sugar diversion for ethanol has come as a big relief. In fact, what we understand is that about 8.5 lakh tons out of 1.7 is going to be diverted for cane juice and the balance for B-heavy ethanol. And as far as C-heavy or C-molasses is concerned, there's no ban. So I think overall it has been, it's a big relief to the sugar sector, which was probably reeling first with likely lower production in both Karnataka and Maharashtra, and the ban which came just out of the blue. So I think it's positive for the sugar sector. And it also shows and it reflects that the government has not put the ethanol program on the back burner. It is still very much on the government's agenda. So I think that's something very positive for the sugar sector.
Mr. Chaturvedi, just a quick follow-up there. The fact is that because of erratic rainfall, there was a hit on production. Prices did go up, sugar prices did go up, and we did see that if push comes to shove, the government will prioritize food and retail prices over its ethanol blending program, at least temporarily. Is that giving you enough comfort to invest more in the ethanol production infrastructure that you require? Because there is no guarantee this can't happen again, right? It was because of low production and erratic rainfall.
No, I totally agree with you. When push comes to shove, obviously food is going to win compared to fuel. That goes without saying, but we must also understand that Government of India and our Honorable Prime Minister has been spearheading the biofuel campaign worldwide. He is emerging as the leader of the biofuel. So it would send very wrong signals if India were to withdraw. And secondly, our calculations as far as sugar is concerned, it's not all that bad. In fact, India still is going to be sitting with a hell of a lot of sugar. So I don't see any reason why more and more sugar should not get diverted to ethanol. In fact, and contrary to what you all are thinking, sugar prices in the country have not really gone up. If you look at the international sugar prices, they are closer to about 65 to 70 rupees a kilo. Whereas in India, a consumer is so heavily insulated that you're still buying sugar at 36, 37 rupees a kilo. So I think Indian consumer has been pampered a lot too much. In fact, I come originally from the edible oil sector. Last year, just after COVID, edible oil prices had gone up by almost 100 rupees a kilo. But whereas sugar prices in the country have just only gone up by 2 or 3 rupees a kilo, and not even that. So why should we be too bothered on that count? This is what beats me, and it doesn't seem logical to me.
Indeed, Mr. Chaturvedi, I mean, the price of sugar is nowhere as compared to any other agri-commodity that could be far more significant in the scheme of things. But great talking to you. For now, it's a relief, so good luck and congratulations. Praful Vitlani, founder, chairman of All India Sugar Trade Association, joins in. Morning, Mr. Vitlani. Thanks for joining in. Mr. Vitlani, your industry gets whacked in various directions time and again. I believe the industry itself, barring the South players, have invested over 15,000 odd crores in ethanol. The minute the government came under pressure in terms of supply for sugar, it did a bit of a U-turn on ethanol. Of course, there is an interim relief here, but moving on from just an immediate reaction today, how does the industry, how do you feel about what's going on with the sector, and whether or not there is a long-term strategy ever going to come into play?
Tamanna, thank you very much for calling Aista on NDTV Profit. I would like to say that the follow-up to Prime Minister's vision of 20% and on 15,000 crore has been invested. This thing is dependent from sugarcane is that first priority, the quantity required for the consumption of India is always from the government, not today, in future, every time. Then second priorities come for the ethanol, and the third, if then also we have excess of sugar or sucrose, then it will go for the exports. So these are the very clear policy from the government of India. So we don't find anything, but yes, we pray that always there should be a good policy to have more sugarcane. I have in past said that like IT sector, the sugar industry can be a new chapter in Indian economy if the raw material is available properly. What is our requirement is opening stock of minimum 6 million metric ton and 29 million metric ton of sugar. So 6 and 29 is 35. The concern among the government was that there could be a hand-to-mouth position in the end of 2002-04 season, somewhere between May to September or so. We are comfortable till May, but if we need sugar to be imported, that will be a drastic for any ruling government India. I agree with Atul Bhai, whatever he said. As he said, one thing that outside the rates are 65, 67 and here it is 36, 37. In this case, government is in painful that if I have to import the sugar, it will cost 75 and there will be a huge cry on sugar price.
Right.
So at the time of election, so they have taken this step. Yes, for the future, AISTA has demanded the sea molasses price to be increased. And we definitely expect that by Wednesday or maybe in next Wednesday cabinet, it could be raised by 6 or 7 or 8 rupees per litre. And that will be the second relief from the central government and a clear message to the all investors that sugar ethanol chapter is not closed,
Right. You're right, Mr. Vitlani. It's a tight rope to walk for the sector, but for now, there's relief. Those stocks are looking well placed and recovering some of the losses from last week. We have with us a very special guest, Gautam Shah, founder and chief strategist of Goldilocks Premium, joining in. Gautam, hi, this is Samina, and firstly, apologies. I know we've kept you waiting, but we had sugar that was the big talking point this morning, so we had to quickly do a little bit of a detour there. But apologies once again. But let's talk about the Nifty, Gautam. It's great to have you in a morning when the markets are taking a bit of a breather after a very strong run-up over the last couple of weeks. What are you doing on the Nifty? It is a morning of consolidation. Is this an opportunity to buy, or would you still wait if you were going fresh?
Good morning, and thanks for having me. Well, I think it's really been a fairy tale-ish rally all along. These last 3 or 4 weeks, with just about every sector in the market doing well, many underperforming stocks and sectors coming back. And it's good to see the market take a bit of a breather, because I think this was a little needed. And we've just moved in tandem with the global markets in the last 2.5 weeks. I mean, US markets have seen a very similar kind of a run up, and our working number on the Nifty was about 21,500. So we hit this number on Friday, and we seem to be consolidating. But given the fact that liquidity is still so strong in the system, the tailwinds, the positive tailwinds of news flow continues to, hit us. And also the fact that seasonally, this is a period where markets end up, being more on the positive side. So keeping all of these factors in mind, I think we will continue to trade with a positive bias. No rocket science to say that we are overbought, but then in strong bull trends, we can stay overbought for a long period of time and still continue to do well. So maybe the index does not see a great move from here. Our medium-term working target is about 22,300, so gradually we should get there. But in the interim, there could be some, much-needed consolidation before we actually move higher. But as we've been talking to our subscribers, I think this is a market where you need to be stock-specific and theme-specific. And like sugar, there are many themes in the market, like fertilizer, power, infrastructure, PSU, pharma, IT, where I think the opportunities are immense, and therefore, your viewers should be looking at committing there.
Very good morning, Gautam. This is Tamanna here. Absolute pleasure to speak with you on NDTV Profit, especially as we're looking like we're going to cap off a very exciting end to 2023 and go into 2024, where most things look positive. So I just want to take this opportunity to get a broader view from you. As such, the big challenge or the big question mark for the markets from an Indian perspective, which is election uncertainty, seems to be out of the way. Having said that, what in your view are the big possible headwinds on the horizon? Or is it all looking up and up?
Well, no, I know it feels like it's all up and up and all's well forever, but I think that's not how markets are. We've seen issues come, out of the window in a day. And we still have a lot of risks around geopolitical factors, around interest rates, around oil prices, around inflation, and for that matter, even in elections, because I think a lot of it is already discounted. People feel that a lot of positives are already discounted in the price, so the risks remain. But, I've been a firm believer that post-March 2020, this is a different India from a liquidity perspective. People like to compare today's bull trend with what happened in the past, but I don't think it's comparable because today's entire bull trend is domestic liquidity driven. You still have 16,500 crores coming into the system every month, and out of that, 50% is going into the mid caps and small caps. So I think the India's outperformance will continue. A lot of themes, which have done well will continue to do well. This is becoming a very stock and theme specific market. We might be slightly on the expensive side on the index and on the large cap. So you might not see a very big rally, but if you are in the right stocks, you are in the right sectors, which is in the form of IT, pharma, auto, metals, which we like, I think we should be okay. So don't expect fireworks on the Nifty because I think it's already done quite well and a lot of the positives are discounted. But going into 2024, I think it's just about sector allocation.
And a few months ago, you were quite concerned about Bank Nifty. We did believe that the worst was not behind it. They weren't participating effectively, be it the large cap names or the mid cap or the small cap banking names. Things have changed dramatically since then in the last 7 to 8 weeks. Bank Nifty is inching or trading around levels of 48,000. The bias is very clear on the upside. Are you now bullish on the banking space, or do you think that rally between 40,000 and 48,000 is pretty much all the steam there left, or do you think this rally for Bank Nifty still has more legs?
Well, the way 2023 has played out, you can't hold a view for the entire year because I think 1 year is playing out in 3 months. That's the new normal, the way I see it, having seen the markets for the last couple of decades. Yes, there was a time when we were not very comfortable with the Bank Nifty because many of them are underperforming. I mean, even at these levels, if you look at an SDFC Bank, it hasn't done anything special. I mean, people are still talking about underperformance and a lot of money managers are facing issues on underperformance even now. But things have changed, and whenever Bank Nifty does well, it really helps the market look a lot more vibrant. And that's what has happened in the last 3 weeks. We actually changed our stance completely 3 weeks back. In fact, right now we are as bullish as ever. And we do believe that Bank Nifty and IT together is helping this market move higher. And I do have a working target of about close to 50,000 on the Bank Nifty. So I think we will get there. And it will be led by an SBI. So I'm still not a big fan of SDFC Bank. I think it will just be a market performer. But there are smaller pockets in the Bank Nifty that could actually stand out. So I think banking and IT put together, because it's almost 60% of the weightage of the Nifty, I think should propel the market higher or could keep it on the safer side.
Gautam, just because you mentioned IT, now are you liking your mid IT companies better? Are you liking your, big companies, your big boys, as they're called? And do you think that the outlook actually continues to be that positive? Because there is some concern that at least Q3, as far as numbers are concerned, as far as their balance sheets are concerned, is going to continue to be a quarter of pressure.
Well, concerns have been there for the whole of this year, Tamanna. I think that's how IT has played out. I mean, it's so interlinked with the global framework that, anytime anything happens in the world, IT becomes the punching bag. And we've seen it a few times. But then it's come out of this situation number of times. And as we speak, look at the kind of rally that we've seen in mid-cap IT stocks. I think they have been in a structural uptrend, and we've been recommending our clients to just stay on, just tag along without worrying too much. But in terms of fresh entry, I don't think mid-cap IT can be bought at these levels because the risk reward is not the best. I mean, you have many of these stocks that have appreciated 50 to 100% in the last 15 months. and it's really been a structural uptrend, irrespective of the market direction. But the big boys, I think that's where the opportunity is. HCL Tech Mahindra, TCS, Wipro, Infosys to a certain extent. I think this is where the real opportunity is, because your downside could be about 5 to 7%, but the upside, even from here, is about 15 to 20%. This kind of an upside I don't see in the index. I don't see in many other sectors, but IT definitely stands out, given the fact that it's coming out of a long base building process.
Gautam, I just also want to get your take on the whole renewable story building up. Today you had another company talking about their target of, having 60% of their energy source as renewables. It's the big theme across sectors, from renewable financing to companies producing hardware, etc. Do you think this is a theme that will fructify further in 2024, and anything you like in this space?
Well, we don't look at things very closely on the fundamental side, because, we are more of a technical research firm. But I do believe that power and energy is a very big theme, which is here to stay. And I think it's a structural story which will work out over the next 3 years. And some of the big stocks, like Tata Power, CESC, JSW Energy, and some of the other transmission companies, they all look super solid on the charts. So I think, yes, it is an opportunity. But, today is the kind of market where you have to be very stock specific, because within a same sector, you have one stock which is outperforming and you have one stock which is languishing. So I think it's very important that you are in pockets, or you are in themes which are moving with the market.
I want to quickly talk to you about gold as well. I know you usually hold an opinion on gold, and today also marks the day when SGBs will be launched. Exactly a year ago, gold SGBs were launched closer to 5,400. Today it's closer to 6,199. We also have another SGB coming up in Feb. Technically on the charts, how is gold looking? Would you recommend a buy on gold, potentially through the SGB route?
Well, I think for the last couple of years, for us, gold has been a no-brainer buy. I think it's just been in a strong uptrend all along. All dips have been bought into. And in today's world where, anything comes out of anywhere, the first thing that moves is gold and silver. And you've seen a fabulous move in the last couple of months. I think gold internationally tested a level of 2,100, and then we saw a bit of a downtake. But from current levels, I do see gold and silver actually beating equity market index returns over the next 6 to 12 months. So gold and silver definitely should be bought. SGBs should be done. I am looking at a 15% move from here, possibly an eventual target for about $2,300 to $2,400 on gold, and possibly $29 on silver, which is also a 20% move from here. So I think in today's world, diversification across markets, across asset classes is extremely important as we get into a very important 2024.
Right. Gautam, you've already identified a few themes that you like, but over the next 6 months, what are those stocks or sectors that you'd bet on? You've talked about IT, there's pharma, there's automobile, a couple of dark horses that you would bet on right now for the next 6 months.
See, I think at a 21,400 index, risk reward plays a very important role, because everything is being painted with the same brush. Excel sheets are out trying to discount the earnings of the next 5 to 10 years, which I don't think is the correct way to do things, because, we live in a very disruptive world. But as things stand, I think pharma is a sector that we really like. I feel the index can deliver anywhere between 15 to 20% upside. It's been a phenomenal comeback in the recent past. So that's a space that we like. Auto, I think, has done extremely well, and I feel this trend is going to continue. So the likes of Hero Moto, Eicher Motors, Bajaj Auto, which has been such a beautiful uptrend, Tata Motors possibly going towards 1,000. So, this is, again, a space that we like. A fertilizer has been a sector that we've liked. Real estate, I feel, is a structural story, because it broke out of a 10-year range, and thereafter, stocks have just run away. So I see an opportunity there, but maybe on dips, one can look at investments. So at this point, I think pharma, auto, fertilizer, and power, I think would be the 4 spaces that, we are very positive, and commitments can be made at current levels.
All right, thank you so much, Gautam, for speaking with us. Gautam Shah of Goldilocks, talking about what is driving the market rally and what kind of a year that we're going to have. We're going to take a very short break at this point, but stay with us because next up we have Ramesh Iyer of Mahindra Finance in our studios here at NDTV Profit to tell us about the company's plan to foray into the insurance business and, of course, a lot more. Stay tuned. Welcome back. M&M Finance, a key NBFC player, has planned to foray into life, health and general insurance. These plans being subject, of course, to approval from the insurance regulator. But moreover, Mahindra Finance has a very good hold on the rural finance space. To talk more about this, I'm joined now by Ramesh Iyer, MD and VC, Mahindra Finance, who's in our studios here in Mumbai at NDTV Profit. Welcome, first of all, Mr. Iyer. Great to have you here today.
Thank you.
Let me begin by getting your sense about the space that you are in, because a lot of questions now, while we see phenomenal GDP figures, we see great growth, is about whether rural India is catching up or is in the same space. What is your sense here?
So, last 4 or 5 quarters, if I look at, it's been a fantastic story out there. A lot of excitement. I think the sentiments are very positive. And typically rural, we look at 3 cash flows which add up to what's happening out there. One is the tourism. So we see how is the people movement. Second is we look at how is the crop cash flow behaving. So how has been the farm. The third is the infra story. If you look at all 3, I think rural has been doing extremely well. And then if you look at our own numbers, right, we've had phenomenal growth in terms of disbursements are concerned. And the real measurement from a rural perspective is how well is your collections doing, how is your delinquency, and all of that is doing pretty well for us. Yeah. And the gone by festival season was, I would think, one of the best.
Mr. Iyer, one factor that pulled down your bottom line in the second quarter was that GNPs had risen slightly by about 200 odd crores, resulting in nearly 100 crores of additional provisioning that you've done. And now, historically, we've seen the second half of the fiscal is usually quite good for the rural economy. You've mentioned how Dussehra was amazing. Diwali has, I believe, kept its promise and actually been as good as Dussehra, I'd like to believe. Will this help your GNPs come down below 4% in the next couple of quarters? And I'm not expecting a forward-looking statement, but just to get a sense from in terms of the outlook.
So let me first even put out on the first half went by. Never before historically was our GNPA lower than March.
You're right.
And this was the first time that we saw that in the first half of the year, the GNPA number was lower than even March. Yeah. So that's a good news for us. If you look at our collection efficiency, which has been putting out every month, has been upward of 92, 94 plus. And therefore, if you look at the second half, which is the best always, and I think the monsoons have ended up well. The sentiments are positive. We just talked about the festival sentiments. We talked about the infrastructure that's happening out there, the roads, so the labor and the assets that are getting deployed. So I don't think we have any reasons to worry about or to believe that the second half would be as good as we have always seen in the past.
But it will be better.
Yeah, it will be.
Okay. But did your tractor write-offs not increase, at least, in Q2? Are you seeing any kind of a pain over there, or are you seeing a complete revival?
I think, we should always differentiate between GS3 and an eventual write-off. Our GS3 numbers always used to be a little higher because of the cash flows of the rural market. But you look at our credit write-offs, it's never been more than 1.5%. So these customers, though delay, don't default eventually. They pay in an extra time that they want, and as the cash flow improves, they pay off. So let me give you one quick example. During the COVID second wave, in the first quarter, our gross NPA, that is stage 3, went up to 15%, right? As the market started opening up, people come back to work, we saw it climb down now to as low as below 4%. So these people don't not pay, while they may delay because of their cash flow.
So what does that mean for provisioning then? Because that was elevated again, we've seen. Is this a conscious business decision that you've taken? Is it part of some strategy? Or and also any specific areas you're providing more for now?
No, so clearly look at the customer segment that we work with. They're all earn and pay segment.
Correct.
Right? So they acquire this asset. So when they acquire this asset, it is to earn from that and pay. And unfortunately, when the assets are not put to use, there's no point in pressurizing the consumer to pay, right? Where will they bring the cash flow from? So therefore, consciously, we have taken the decision to partner with these customers even during their difficult times. I think in this business, what's more important to really understand and really learn from is what's the difference between circumstantial and intentional defaulters. And if they are circumstantial defaulters, that's a model that we have got into.
You've already priced that in any way.
Exactly. And therefore, if they are intentional defaulter and if you have made a credit judgment error, don't delay the decision.
How would you, though, know about intent? How would you decide for that? What's the filter for that? Because that's seems
a model,
like,
right?
That seems like a bit of a discretionary call at the end of the day. Or
that's a
no?
model, right? We have 1,300 branches. We have 10,000 people on the street. There are people who've been locally recruited, and therefore they have a phenomenal connect with the consumer base there, one. Two, we know what works there in the sense which asset is put to use and what's the earning from these assets. So if I have lent to you on a vehicle and I see your vehicle being used, and if you're not repaying, I don't have to double guess, right? I would put it in a category of intention not to repay. Right, but if you were to come back and tell me that, oh, I took this asset from you, this is the reason I took it, I have lost this business, and therefore my asset is not in use, I would rather take back the asset and transact and give it to someone else for a better use. So I think the local connect is super important as far as we're concerned, and understanding of where the assets are deployed. And we have many customers in the same use.
So it's all referral, especially this rural business is backed by referrals largely, right? Family, extension,
touch business, local knowledge, speak the local language.
Very different
So it's a model which is very homegrown locally to suit these requirements.
Now I want to, Mr. Iyer, just move the conversation a little bit and talk to you about your NIMs. The current outlook on the rate cycle is such that we should be hopefully getting a rate cut over the next 6-month period. Of course, it's been delayed from what businesses were initially anticipating. What is that doing to your borrowing cost? And what are you penciling in? Because I know your NIMs were pressurized slightly because you all hadn't moved, hoping that cost of borrowing would come off. That hasn't happened, but now we still have some visibility on that. Are you working on it? What are you going to do? Is there sort of changes that we can expect or status quo, and then the impact of that on your NIMs?
So clearly, we were also expecting the rates would come down, and I'm on record to say that we thought around festival time one would start seeing the rate cut, but that didn't happen. And we delayed our decision to obviously increase the lending rate. And we didn't want to do it, obviously, at a time of the festival. The sentiment was so positive, why spoil it? And therefore, we delayed it. We've already increased our rates across the board for all products by about 20-25 basis points. This is something we will definitely get benefit of. I think the other way to look at the NIMs really is to look at the product mix change. Right? If you do more of pre-owned vehicle, then your yields are better, your NIM starts to improve. So that's one of the strategies that we put in place.
And how much does pre-owned vehicles contribute to your top line?
So currently it's about 15%. We do believe it can go up to 20-25% of the total.
Over the next couple of quarters?
Oh yeah, clearly, at least for next 3 quarters. That's the direction in which we are.
And what is the increase in yield that you get there? So I want to get a sense of what that means for your top line margin.
So I think the yield difference between a new and a pre-owned vehicle is at least about 3-4%.
Oh wow, okay.
Yes, right. And therefore, if you do increase your pre-owned vehicle, you get the benefit of it.
So blended margins, expectation in the next couple of quarters?
So we were on record saying that our NIMs had come down to 6.6. I think the first step is to go to 6.8, but then move to 7.1 is what we're looking at in the next couple of quarters.
I just want to get a sense from you on your personal loan book. Because and whether you are doing smaller amounts or smaller ticket size of loans, simply because it is an area of concern in a different context that the RBI has pointed out to. Are you seeing that trend in the rural segment business, or if you can add more color to that?
So need for personal loan is very high. I don't think we can move away from that reality. Even in rural India, when we talk to people, they do need personal loans, and for right reasons. Maybe there's some wedding in the family, health requirements, education to children. All of that contributes to this personal loan requirement. We've consciously stayed away from personal loan in rural because we are still were in a physically touch model, and therefore you lend the small ticket loans, recovery cost is very, very high, right? And that's the reason we are not in two-wheeler business as well in a big way. But what we've done, though, to get into this business over a period of time is to start lending to our existing customers who've repaid extremely well. So we're looking at customers who have repaid our personal loans for the last 12 months. Therefore, we have their credit history, 1. 2, we at least have another 2 years of loan going for the vehicle, in which case we are still in touch with the customer. And therefore, if these consumers want a smaller loan, then we are willing to provide this loan, and it's in a way collateralized by the underlying asset.
So when you're saying you're seeing an increase in demand for personal loans, can you quantify that, the kind of jump that you're seeing, or are your existing customers coming in larger numbers?
So I may not have a clear number, but then if you kind of do the CIBIL scrub of many of these customers or customers from that market, you'll find that they are all borrowing from some source or the other for their personal requirement. Now, it's also a good news in some way, in the sense that if someone was not to provide formally, probably they will be going to a money lender or a trader.
I was going to come just to that point.
Which is a much higher cost, right?
Yeah.
And therefore, one needs to look at it as, is there a need for such a loan? And therefore, is the need being correctly met? Then I think it's a great format. But it should not be for a situation that, oh, somebody is giving me a loan, let me take it and see what I'm going to do with it. Right? You shouldn't reverse the order. There should be a purpose for which you take a loan, then I think you're replacing it very well. But if you say, no, I'm going to provide you a loan, think what you want to do with the money I'm providing, is not a great story.
Mr. Iyer, I want to talk to you about the co-lending deal with SBI that took place a few weeks ago. How is that coming along, and what does it also mean for the SME part of the business? And also, if there are any more co-lending deals that we should be watching out for?
So I think it's early days while we've signed up, but we see a lot of consumers come to us and they're requiring 5-year, 7-year loan. Maybe they require a low-rate loan. Now, as an NBFC, we don't source 7-year, 10-year money to be able to run that.
Cost of borrowing again
and
gets
we want
off.
to be very clear that we don't run ALM mismatches, right? And therefore, it's a great product working with someone like SBI to offer these kind of loans to maybe fleet operators, maybe to SME. And we would see good traction in that going forward. That's for sure. As far as more deals like this, I think we are very open to be able to work with many such formats because it is to add value to the customer at the end of the day. It can't be that the two of us who sign up will be benefited, so the customer has to benefit.
In this deal, how much of this are you going to be a beneficiary of? And again, what will that contribute to your top line, these long tenure loans?
It's a small number at this stage because only 20% of the book will be with us, 80% of the book will go to SBI. And therefore, this will be for such consumers whom otherwise we would not have been able to lend to.
So it's anyway an opportunity, right?
It's an opportunity, and therefore there will be some add-up, but not a strategically large book at this stage.
One quick question, Mr. Iyer, and this is what I think Tamanna and we've been seeing and talking about pretty much every day with fundraising. Everyone and anyone is out in the market for capital fundraising. Is that on the horizon? Are you looking to raise any funds? You've talked about doubling your asset book by 2025. Can we expect any sort of capital raising exercise?
No, so if you kind of look at our capital adequacy, Tier 1, Tier 2 together is upward of 20%. Tier 1 is upward of 17-18%. So I don't think we need to raise capital in an urgency. Plus we are making sufficient profit which gets added to the net worth. So for the growth story that we are talking of go up to 2025, we don't see that happen.
Talking about that growth story, news recently about larger foray into the insurance space. Can you add any details on that, what the outlook is there, especially considering the policy push right now for an increased penetration of insurance in rural India as well? How do you see that developing, and how excited are you about that?
So we are very excited, otherwise we wouldn't be going in for this. I think clearly we have a broking license, and therefore we were distributing insurance of various insurance companies, both in life as well as health and assets. What we see is getting into an agency makes it even better for customers, because as a broking you can only have so much reach. Through an agency with Mahindra Finance's 1,300 branches, can we go more deeper and offer more product? And as an agent, we can work with at least 5-6 insurance companies and offer this product. So clearly what we are now getting into is an agency. To a broader question of our interest in insurance, I think that's a very, very interesting space for us. We are not yet there in terms of insurance manufacturing, but will we look at that space? I think we've been looking at that space very closely. And as we see that open up for us as an opportunity, we won't miss that.
It's also a space that has a lot of government support or thrust towards insurance for rural economy. But thank you, Mr. Iyer. It's such a pleasure to have you in the studios, understand what Mahindra Finance is doing. Very clearly, lending with a heart is probably the best tagline for them. The stock isn't doing very much this morning. It's a quiet day of trade, and over the last couple of months as well. It's not done as exceptionally well, but nevertheless, holding steady is what we've seen. But the next couple of quarters are expected to be pretty solid for the company. We'll take a break. We'll come back on the other side. We've got Syngene's Jonathan Hunt, who puts light on the company's growth plans. We'll be right back.
Thanks for tuning into NDTV Profit. I'm Neeraj Shah, and we're talking to a business, or there are businesses which are in a state of transition despite having achieved significantly in the life cycle. And Syngene is one such business which has unequivocally been a leader in the biologic CDMO business, and now they are transforming themselves into not just a CRO, which is a contract research organization, but also into manufacturing CDMO, that is, in a meaningful way. And to talk about how he sees Syngene moving from what it is currently to what it could be a few years down the line after having finished 30 years of their existence is Jonathan Hahn. Jonathan, great having you. Thanks for taking the time out.
Yeah, it's a pleasure to join you.
Yeah, and Jonathan, congratulations to you and Team Syngene. 30 years, I presume, is a momentous occasion, but I'm guessing you're looking forward to the next 30 already.
Yeah, I mean, it's worth taking a moment of reflection and enjoying some of the sort of progress we've made over 30 years. We certainly took some time last week to celebrate that and enjoy it. It was a pleasure, actually, how many of the very founding staff are still with us. I mean, they're a little bit grey-haired, and they've been there quite a long time, but it's a pleasure to sit down with some of them. And they've seen so much change and transformation. Okay. I wonder what the next 30 years will bring.
Yeah, it'll be interesting. So tell us, what do you think? I mean, when you look at what's gone by and what you are on the cusp of, or have events that have led you to be on the cusp of something which is different than what the previous few years of Syngene have been, how do you think about the next few years?
Yeah, I mean, sort of, you described it in your comments as on the cusp of transformation. That feels a bit more sort of precipitous than I would describe it. I think it's an evolution, and it's the reason that's important is it's got a sort of consistent theme through it, and it feels organically natural that we should evolve the business in this way. We're pretty much following the way science flows, and we're following the way that our clients, our customers, naturally create value in their business. They start with an idea, that innovative spark off, and it comes out of academia or it comes out of their own discovery. You have a hypothesis that, if we take in human health, a particular biological understanding of a disease, and if you can interfere with those biological mechanisms in a way you can create a drug, a medicine that's useful, you can get a clinical outcome that helps the patient. So they start with those ideas. They go into years of discovery. That's the R&D, or for us, the CRO bit of our business. Scientists in laboratory, prosecuting scientific ideas, running experiments, trying to uncover the truth of the disease. And then they move the next phases into development. How do you take the molecule you've now found and turn it into a medicine? Go from the chemistry to the patient, and that's around finding out how do you make it? How do you make it at scale? What form do you put it in? Is it a tablet? Is it a capsule? Is it an injection? What helps the patient best? And then, of course, doing the scientific clinical experiments to prove that it actually brings that benefit in the disease. And then you move to distribution and manufacturing. So that's a decade-long workflow for our clients. And it flows in one natural direction, and that sets the template for really how Syngene is evolving as a business. CRO to CDMO to CRCDMO. There's so many abbreviations, but fundamentally follow the science, head towards where the patient and where you can have a positive impact.
Yeah, well, which is great to know, but I'm just trying to understand, Jonathan, is heading towards the patient from an investors and a shareholders perspective, which a lot of our viewers would love to understand what kind of business opportunities and challenges does it bring for an organization which has been, in abbreviation terms, a CRO, but moving to a CRO plus CDMO brings.
Yeah. Well, there's multiple dimensions to that. I mean, there's the natural workflow. You hand over from discovery research scientists. As you move closer into the development manufacturing piece, the reproducibility, the rigor at which you operate. If you've ever been around a lab, or you've ever been around a manufacturing plant, you can almost in your mind picture the difference. Often in this, the scientist's office is a million ideas and almost as many papers and research. It's about how do you bring together all of those ideas and think them through. Manufacturing environments tend to be highly regimented, a place for everything in its place, and you have to bring that operational and industrial rigor. And in our industry, almost more than any other, but certainly the match of any other, you overlay a regulatory framework. The FDA in the US, EMEA in Europe, the Indian regulators, the Japanese, many, many regulatory bodies around the world place a high degree of control and rigor around how you operate in the manufacturing environment. So you've got to be able to do both, and that means that you need different skill sets, different processes, different systems, and that's part of the evolution of Syngene. It's one that I think we're doing well on. Evidence for that, even in the last year, we've had 2 of our manufacturing facilities pass their first ever inspections by the US FDA. That's quite a seismic event for any business getting to that standard. We now have the same regulatory status, I think, as any and all of our clients, with our ability to manufacture to the very highest regulated operating standards in the world on both small molecules and large molecules. So we're building that track record, we're building the underlying capability, and that allows us then to offer something that's of real benefit to our customers, which is to flow seamlessly from the research work that we've done for 30 years for them and take that project all the way through towards the patient. That means you can be a bit quicker.